Good morning to everyone in this room, here in attendance at the Orleans, and to everyone joining by Zoom via camera. Welcome to NAIOP, the Commercial Real Estate Development Association's breakfast program. You know, I looked up the definition of commercial real estate this morning, and there was a lot of words, but included in it was apartment complexes, luxury and otherwise. Hey, Jonathan. And we have got the leaders of the most important, well, really all of the apartment developers in this room right now, and I want to tell them thank you for being here and let them know that this is your home and you're always welcome. I'm going to pause. You know what? I need to look at my... Hey, folks. Let's get this program started so that we can get the speakers up here. I'm your 2026 President, Stephen Niger. We have nearly 300 people in the room this morning. I want to recognize our UNLV students attending today. If you are a student, please stand and say hello. Please take the time to introduce yourself to any of the students in the room wearing bright green ribbons on their name tags. Thank you to our student sponsor, Heller Companies. Having UNLV students in this room is an important part of our industry, and they're always welcome. We're going to start with the morning announcements and then get this incredible program that our programs committee put together. First of all, I want to say thank you to the Community Service Committee and our Education Committee. And exceptionally loud today. Our Community Service Committee had a great day picking fruit at Gilcrease Orchard for Helping Hands of Vegas Valley for local seniors this month. Pretty awesome event. And our Education Committee coordinated a construction tour of the new Northwest Opportunity Village and Betty's Village that featured numerous NAIOP members that were involved in developing and building the project. So thank you to all those committee members doing the good work of this chapter. Now I want to take a moment to honor our current President's Circle sponsors. They are critical components to the success of this NAIOP chapter and everything that we do. This year we have 4 platinum sponsors, and I want to make a special thank you to each one of those. Cox Business, who has supported our chapter for 22 years. Lincoln Property Company since 2022. Martin Harris Construction since 2001. And Schnitzer Properties since 2000. Thank you to our platinums. Also want to thank our 11 gold sponsors: Burke Construction Group, Clark County Community and Economic Development, EBS Realty Partners, Heller Companies, Howard Hughes, Kimley Horn, Majestic Realty, Prologis, Southern Nevada Water Authority, UES, and Unforgettable Coatings. Now please take a look at the screens to either side for our silver sponsor recognition. Thank you to all of our silver sponsors. I appreciate you. And our bronze sponsors. Thank you to our bronze sponsors. And our copper level President's Circle sponsors. Thank you very much to all of you. President's Circle sponsors are full of benefits, free breakfasts, event discounts, exclusive marketing opportunities, and most importantly, they are the only way this chapter is the best commercial real estate organization in this town and how we're able to do so many great things. If you're not a sponsor yet, please stop by the front desk on the way out for more details. And now to our committees. I believe we have one committee member doing an announcement, and I'll do the rest. NAIOP runs because of the high quality of our organization's committees, which are made up of volunteer members. Guy Gugino, are you here? There he is. Just trying to prompt you. Right there. Do you got this?
All right, good morning, everybody. Eric here with Right Engineers, here to make the announcement about our NAIOP golf tournament. Per usual, it is already sold out, but we are looking for raffle donations over $100. You can go to our website on the NAIOP, and there's an Amazon link of various items to pick, or anything you want to contribute would be much appreciated. And a reminder, that is May 15th at Paiute. Thank you.
All right. Membership Committee is putting on our annual bowling tournament on Thursday, July 30, here at the Orleans. Teams are available to members. This event always sells out, so if you want to have a bowling team, get yours. They will sell out soon. Now, new member recognition. Each month, we like to recognize our new members. If you are a new member, please stand and welcome to NAIOP. New members, please stand up. Thank you very much. If you see a red ribbon, that means they're a new member. Please make sure they feel welcome. They should never be sitting alone. NAIOP Southern Nevada is currently 744 members strong. Could be 1,000. We'll get there. If you are not a NAIOP member, you should be. Our chapter ranks in the top 7 for NAIOP chapters nationally, which means we punch way above our weight because there are much bigger cities in this country. Something to be proud of. We are only the best organization in town because we've got great members who do great things, and I invite any non-members here to get up and get online and become a part of this group. You can see the folks at the front table, you can go to the website, you can join all over the place, or just come see me afterward. Another reminder about the website, all of these programs for years now have been recorded and published to YouTube for free viewership for all to see. So if you go to NAIOP's website, top left, there's a YouTube icon. Go straight to YouTube's NAIOP profile, and you can find any breakfast program that you want to rewatch. I know a lot of us have done that several times. Thank you to our 2026 breakfast sponsor and our Wi-Fi sponsor, Lincoln Property Group. Today's sponsor is Nevada Energy, who is also one of our Silver President Circle sponsors. As with every breakfast sponsor, they get a couple minutes to come up here and have a chat. I'd like to introduce Chad Jacks, Business Development Executive with Nevada Energy. Welcome to the stage, Chad. Thank you very much.
Thank you, Steve. Let's make sure this thing works. It's not working. Where's Jonna when I need her?
Just holler at her.
Okay. Okay, hi. There we go. Okay. Great. Good morning, everyone. Thank you for allowing me the time to speak. I'm Chad Jacks with NV Energy. We are this month's breakfast sponsor, so appreciate you being here and giving us some time. There we go. This morning, in the next 1 minute and 30 seconds, I'm going to go over all of these topics here. Steve, let me know if I run over time. I wanted to first talk about our economic development and business development website, which offers the following links and resources. I'm happy to talk with any of you about these topics when time permits. Also, I wanted to highlight our discovery packages, which is a process that I help with. You can also submit into our portal. It includes power availability requests, which will tell you when and where the power is, and then we move into a ballpark cost estimate and deliver that in a discovery package so that you can take that with you and present to your client. We're also happy to be involved in these conversations as well. I was told that I had to talk about this slide, but I won't mention by whom. So what we mean by growth pace for growth is that we can assure you that the data center growth in the state of Nevada and NV Energy's service territory is not going to impact our residential, commercial, and industrial rates for other customers. So we do welcome the data center business, but it should not and will not impact your rates going forward. We want to make sure that we're going to protect the rates of our existing customers as well. This here is a snapshot of where NV Energy or Nevada stood in relation to some of the other states in the neighboring regions. The green rectangle there shows that in Nevada, our average rate there was lower than the mountain states in blue, the Pacific region in blue, and also the US average. So I know it's kind of a busy slide, but for 2026, we are projecting that from April of this year until April of next year, our rates are projected to go down, both residentially and non-residentially. 2 years ago, it got applause. Thank you. So now we're going to get into the quick lesson. So I spent a lot of time talking to the development community about amps. I like to talk about KW and KWH, KVA as well. So essentially, this is a model that we use to show what amps represents, and essentially, it's the flow of water. So we all recognize how important water is in Southern Nevada, as well as for life in general. But what we really want to talk about at NV Energy, particularly me, is beer. And so basically the analogy that we use here talks about the KVA, which is what I need to help you with your power availability request, as far as that includes everything that's in the glass. We'll take KW as well, which talks only about the beer, essentially. The KVAR, we're not going to get into it. That's the foam and makes us burp. Moving right along, business energy services. I talk about this every year. We want to make sure that developers and end users aren't leaving any money on the table. So we do offer energy efficiency rebate incentives for new construction, as well as retrofit. We have an energy model for new construction that we can use, which typically reveals more energy savings, dollars back, than the prescriptive route. We have retrofit. We have technical assistance that we offer, and we do a monthly free lunch and education session. And then also I wanted to mention that the business development team has recently teamed with our business energy services, our energy services team. Some of them have joined me in the meeting today to come together as a team. So hopefully we can build some synchronicity there to help folks save even more money. Lastly, I wanted to identify some folks that I've worked with over the last couple of years who have been enjoyable to work with and who I've been able to help out and hopefully show them power availability in different parts of town and give them the ballpark cost estimates and perform discoveries. If you want to know if your company's name is on this list, just come see me after the presentation, or yes, it is. Thank you.
Thank you very much, Chad. All right, on to the program. Reminder that for all of you here in the room, we have a Q&A session at the end of the program from 9 to 9:15. For our in-person attendees, there are notepads and pens on your tables, which will be collected by Dan Tutland today. Dan, are you here? There he is. He'll be walking around, so feel free to flag him down if you've got a question. I'm excited for our program today, multifamily and affordable housing, navigating today's reality. I'll be introducing our speakers and moderator and handing it off to our moderator at Vance. Miranda Dean, come on up. Miranda leads all debt information initiatives and co-leads private equity capital raising for the Calida Group, Nevada's largest market rate multifamily developer. Mrs. Dean is responsible for identifying and acquiring and building relationships with institutional, high net worth, and family office investors, as well as lenders to support the firm's development acquisition strategies. Welcome to the stage. Jonathan Fore, managing partner at Fore Property Company, a full-service real estate firm focused on developing, constructing, and managing multifamily housing across the U.S. Since joining in 1999, he's overseen all aspects of the firm's ventures, from land acquisitions through operations, and has developed more than 15,000 units with current projects in Las Vegas, Southern California, Phoenix, and Orlando. Now, Armen Hadjimanoukian is Director of Development for Ovation. where he spent nearly 10 years helping deliver both market-rate and affordable housing communities across Southern Nevada. In his role, he oversees the full development process from land acquisition and entitlements through financing, design, and construction, with a focus on creating high-quality housing that serves a wide range of residents. And Tim Veenstra, please come to the stage. He served for 6 years as the Chief Operating Officer for Nevada Hand, the state's largest all-affordable housing development, construction, and property management company. Previously, Tim was the Director of Asset Management for the Illinois Housing Development Authority and worked for 20 years in a variety of asset management and development positions at the Chicago Housing Authority. And now our moderator today, Mr. Edward Vance. Come on up. He is the founder and design principal at EV&A Architects in Las Vegas, bringing over 40 years of experience across healthcare, hospitality, and commercial design. A former president of JMA Architecture Studios, he is a fellow of the AIA and served as chancellor of the AIA College of Fellows in 2019. His work has earned numerous honors, including the AIA Nevada and Regional Silver Medals. Welcome to the stage, everyone, and over to you, Mr. Ed.
Let's turn this thing on. Is it working? Is it working? Good. Okay, we're going to have some fun today, and I appreciate everybody being quiet. Thank you. We have an incredible group here, and they represent, well, that's my valet ticket. You don't need that yet. Of developers who have been working hard in our community, providing housing for a much needed group of individuals who keep moving here from, well, I'll let you guess. So thank you all for being here. We've got a tremendous depth of experience here. And they span the capital markets, development, and long-term operations. So let's dive in. I think we're at a critical inflection point. We've been experiencing pretty sustained population growth and continued economic diversification, something we're all working on each and every day. Yet at the same time, the cost of delivering housing, particularly attainable housing, has never been more challenging. So today's conversation is grounded in the following. Southern Nevada is still growing at about 40,000 people a year, and we've been doing that for several years, which should support a strong housing demand. We can all agree with that. But over the past 2 years, we've delivered roughly 15,000 new multi-family units. You can't drive around town without seeing an apartment building being built. And absorption, while positive, hasn't kept pace. So we've shifted that supply-constrained market to a more balanced one. And occupancy, unfortunately, has slipped from 95% to about 90%. Now, these are facts you probably already know, but the audience probably doesn't because this is your business. So given this new reality, how are you and your companies responding with respect to your individual mission sets? Miranda, let's start with you. It's a big question, sorry. Want me to repeat any part of it? Let me know.
Yeah, so good morning, everyone. I'm excited to be here representing the Calida Group. I think the question was more so, how are we shifting to address the growing population in the Valley?
That's the demographic. Yeah.
Okay. So at the Calida Group, we develop market rate multifamily. We are the 20-year-old company. We've been around, over those 2 decades, we've developed and or acquired 35 properties throughout the Valley. And we're also active in the Pacific Northwest as well as in the kind of the Southwest into the Southeast. And what I would say is in regards to meeting growth where we're seeing it trend, and especially over the next couple of years, because Las Vegas does have a pretty healthy growth rate continuing forward into the next 5 years, is frankly bringing in more capital. A lot of these projects are contingent on healthy population growth and healthy job growth. And I think a lot of investors that are out there, we typically partner with institutional groups as our capital partners for these projects. But a lot of them are looking for cities that are just robust, that have a clear path to growth, that have, a pretty healthy concentration of middle to upper incomes. And they frankly just want to know that the renter base is going to be kind of a core profile for the long term. So we're trying to, put ourselves out there in terms of how we represent the city of Las Vegas and really represent, where we see the growth and why we think it's so durable.
Okay. The rest of you feel that bullish? Jonathan?
Yes. Yeah. Can you hear me okay? First off, thank you for having me. No, I agree. I think I remain very bullish on Las Vegas. We develop in 8 different markets, and Las Vegas remains one of the top 2 markets that we like. Fundamentally, it still has strong job growth, and fortunately, we have the challenges in California that cause people to come here. I think there's challenges in Washington. We're seeing people coming here from Washington now, but the fundamentals stay strong. I do think there's been a period of time where we've had sort of increased supply being delivered, but that's coming out of the post-COVID development period, where we saw a lot of starts. But over the last 2 or 3 years, those starts have pulled back, so we will see deliveries pulling back here. And so I think we'll get back to that undersupply market, and so we'd like to be developing into this into this market. We are looking to break ground on 2 deals here in 2026, and we think it's the right time.
Okay, Armen?
Yeah, and I think I'm actually positioned well between the group, being both on the market rate side as well as the affordable side here. So Ovation does both market rate apartments as well as affordable. Since 2022, Ovation has not broken ground on a market rate community, and that's due to the rising costs and economics I'm sure we'll get into later. But at its core, we're great builders, and so what we got into the affordable housing, like that business line back in 2013. And so leveraging kind of this slowdown in market rate apartments, we're great builders, we're in-house contractors, and being able to focus on delivering affordable housing communities during this time.
Okay. And that leads perfectly to you.
Yeah, so from Nevada Hand, Nevada's largest all-affordable developer, nonprofit. We all live here in Southern Nevada. We have about 5,400 units, all just right here in our visible range of our eye here. The demand for affordable housing, of course, is very high. There's been a little bit of softening in the market for the last 6 months or so, maybe. But we have occupancy rates well above the market rate because of the restricted rents that we offer. Our rents, so of our 5,400 units, about 3,000 are restricted to 55 plus seniors, and the rest are for families. We have rents ranging from about $500 up to $2,150. So our most expensive 4 bedrooms just broke the $2,000 mark, but they're all regulated, restricted because of the funding we receive to build them. But the demand is strong generally across the board. We do see a little bit of concessions on some of the units. 2 bedrooms for seniors at our highest price point are more difficult to lease. That's $1,377 for a senior on a fixed income is harder to rent, obviously, than one that's under $1,000. Our average rent across the portfolio is about $900, and there is strong demand for that product.
Great. So the gist of my questions are always going to be, what are the challenges that you're facing? And we're going to try to do this in order, even though when you develop something, it's rather cyclical, not linear. But in every development project, we always have to start with one thing, and that's land. So if you would be so kind as to say, or tell the audience, what challenges are you finding relative to finding where you want to place your next project?
Yeah. So for land, we like to be around $1 million an acre or less. Obviously, if we can get it free from the BLM or somebody else, that's even better, or a government entity. Great. It's hard to find that. We also don't want to buy land without entitlements, so we need to find a patient seller who's willing to sit on a LOI with us while we get entitlements, because we don't want to be holding land that we cannot build on. So holding costs become an important issue for us. Our next project will be at Las Vegas and Serene, Las Vegas Boulevard and Serene, and that's a $40,000 a month holding cost for us. So it's not insurmountable. We can do it. It's just you're still paying somebody $40,000 just to hold the land until you can close. So we watch that. Finding the right size parcel, we need at least 5 acres. We can do a little bit less, but 4 to 20 acres, finding that right piece that doesn't have too much infrastructure needs and close to amenities. We don't want to be too far out. We don't want to be in the middle of a mess either. So,
and on Tim's point, he mentioned federal land. So Ovation has a community we're going to be breaking ground on in the next 4 months, and that's a BLM piece. And we have a program in Southern Nevada called SNPLMA, the Southern Nevada Public Lands Management Act, that allows for affordable housing to be granted over at $100 an acre, which is really obviously at $1 million acres the target, but really pricing's at $1.5 million. And so that's a great public-private partnership to be able to deliver housing in these times. I think part of the challenge, though, is infrastructure as we start sprawling further out. And it's priced into the land, but infrastructure costs of getting utilities out there definitely burdens a project at times. Ovation's also interesting that we have a decent amount of land that we own in the valley. But given that we're still not able to make communities pencil even at this moment with the cult land bank that we have.
Right.
Yeah, I think there's 3 levers we can pull to make a development deal work. It's obviously increased rents, lower construction costs, and lower land costs. And the construction costs are obviously facing some challenges with labor and tariffs. And so, to get these deals going, we really haven't seen a reduction in land costs in the Las Vegas market over the 2 or 3 years, and that's sort of why we're sort of in this reduced starts environment. But we did take down a piece of land last year that we're going to start with this year. So, the deals that we feel really excited about, we're taking down land. But other ways we're getting deals done is JVs with landowners, getting them to put in the land. So, there's different ways to skin a cat.
Were they subordinated? And, Yeah.
And then, we had a deal that was just under development where the landowner stayed in the deal as well. It took some money, but then, he had a price in mind. We couldn't quite get there, so he stayed in the deal for some back-end profit.
Yeah, I would agree. I think across the board, land has become and will continue to be more and more of a challenge throughout the valley. For us, I think everything that has been said is pretty par for the course for what we see at Calida. But I think a few things that we also keep in mind is just the availability of larger lots that are, ready to develop. And so we typically are looking for anywhere, call it north of 6 acres. 6 acres is probably the small end of what we'd look for in order to build. And, we're building garden style, so we need the space for surface parking, for lower density, things like that. So land availability is key.
Right.
And it's actually one of the things that when I have investors that are in town and we're just driving around, they see all these empty lots and they're like, there's tons of available land to build. Yeah. And my first comment is, it looks like that, but it actually is not available for one reason or another, depending on who the owner is, depending on what the zoning is, et cetera. So I think that's a perception and frankly a reality that we are going to continue to face going into the future. For us in particular, most of our equity partners do not like to come into deals unless they are permit ready. And so we end up not taking down land until we are kind of right at that stage. And it's really because equity nowadays doesn't want to take that pre-development risk. The third point I'll mention is location. So we have, our house brand is Elysian. And so you guys may have seen a lot of our properties, we try to front freeways because you get a ton of foot traffic and it becomes just a natural marketing machine for you that you don't, well, I wouldn't say you don't pay incremental costs for, but it comes from the land, right? Not your actual marketing spend. And so finding sites that have that kind of access and visibility is also becoming more difficult.
Yeah, so site selection is incredibly important. You segue perfectly into my next question, which is, as I mentioned before, developing is incredibly hard. What we do is difficult. And I give developers the greatest respect in the world because what they do is even harder, because they have to take so much more risk. When they hire us, we're not at a great deal of risk. But they certainly are, and I've watched a lot of my clients make millions of dollars and then lose $1 million. So when they are successful, we need to applaud them and congratulate them because they have gone, out and beyond what they probably have the good sense to do. So I'm going to ask you how your process works. And just like Chad talked about beer, there's metaphors out there, right? And we're going to get into some lasagna financing later, just kind of in your, and I'm going to ask Tim about that one. But the other metaphor I use is a three-legged stool. When you develop something, you have to have you have theories on whether that property is the right one, right? And what can you do with it? So you have the first theory is what can I get on the property, right? And I've got to figure that out. So there's going to be a test fit required. And that's where those incredibly invaluable architects and engineers come in. So that's the physical analysis. The demographic analysis you're either doing internally or you're using the John Restrepos out there, and I'm not sure if John's here today. So that's the other theory you need to prove. And then the last one is the financial analysis. Those three things have to be all satisfied in order to give you a green light. Is that not correct?
Absolutely.
So how do you go about going through that process? Which comes first for each and every one of you, and what's second, what's third? We'll go back to you.
Ooh, that's a heavy question. It is, I mean, it's a mix of all three, right? You're first looking at just your demographic profile, and I think I mentioned it earlier, a lot of demand. The essence of it starts from population growth and job growth, right? You need more household formation in order to justify more households. And whether that's for sale or for rent, like that is the essence of your math equation, if you will. From there, it turns into, site selection, building cost, ability to actually move through that pre-development process successfully and to keep all of your, for lack of better terms, all of your doors open. And so that part is a challenge, but I think right now, frankly, it's the finance side, right? We have plenty of projects. I think Armen said it earlier. You've got plenty of projects that might be permit ready or you're already land banking and you feel pretty confident about, your ability to convert that into an existing cash flowing property, but you just don't have the returns that justify doing it today. And that might be based on where rents are. It might be based on, for people like us, the availability of capital. And so that becomes the real, I'd say the real focus point that you're trying to solve for as early in your process as possible. And unfortunately, right now, we're in an environment where a lot of investors don't want to move too early. I think if you're looking back at 2022, you had a lot of investors that were they had so much capital, they were so ready to just whip out a check and, move things forward because they needed to secure the investment for their own portfolio. Today, there's a lot more caution, there's a lot more wait and see, there's a lot more posturing with their end investors. And so it just makes it, frankly, a higher economic bar that you have to clear.
So the climate has changed.
Yeah.
How do you see it?
I see it, the same way. I think it's the demographics first that we identify. Even here in Las Vegas, there's different pockets and so you can get different rents in different areas, and then it's the site, and then what you can do on the site. How big the site, how many units you can get, infrastructure costs to getting the utilities there, how high you're going to go, type of construction you're going to do, and then it's the economics and the financing. We put it into our model. Miranda brings it up. 2000 21 and 22, you were sure people were going to be there wanting to do your deal. It's a little harder these days. Construction loan pricing has sort of held steady, but it's the equity that's sort of, very cautious to dip their toe into the water. And it's, it's a little bit of Las Vegas, but I think it's, more nationally. There's just a lot of uncertainty out there on the global scale, and just people are just afraid to put money to work right now.
Right. Do you do your own pro formas? You do your own financial analysis, right?
Yeah, absolutely.
Each of you have probably developed your own spreadsheets, and you're not showing anybody any of your homework, are you?
No.
So.
No. Yeah,
Armen.
and to Miranda's point, every site Ovation owns is fully entitled. 3 of the sites, we actually have fully drawn sets of plans. Going back to kind of those sub-market specific areas, at the end of the day, barring the original land basis and the infrastructure costs, it generally costs the same to build in the Southwest or the Northeast, like framing and all of that. And so it is trying to understand those parts of towns that are going to give you a higher rent, not just because you're chasing a higher rent, but just because the deal relies on it because of the cost of construction and all those different factors. And so really, we have one site in a premier location we believe in. I think from the equity standpoint, there are definitely a lot of macro concerns, but there was a lot of supply or a lot of delivery that came online, and that absorption has led to concessions in the marketplace. And so it's trying to really understand what is the true effective rent right now, and that's part of that balancing act.
Okay. Tim?
Yeah, from the affordable side, I guess one thing I always want to make clear is developing affordable housing is really no different than developing market rate housing. We still have to do site selection. We still have to buy land generally. Construction techniques are the same. There's no secret or magic to nonprofit affordable development. It's the same. So we have to do site selection. We have to pencil out the construction costs, design it, lay it out with our architectural team, and figure out the timeline for financing. There's 2 or 3 different common financing packages, and you need to figure that out usually pretty soon in the process to know which path you're going on, because there's timelines associated with the money that comes with it. The big difference, the big secret is, if it's a secret, is that we don't have a $30 or $40 million debt mortgage to be paid. So we have a mortgage to pay, but it'll be $5 million or $3 million. So the other money is coming from other sources. We might have a slightly bigger mortgage. It's maybe 30 or 40% of the development cost, but not like you would have in market rate housing, where it's the bulk of the construction costs or development costs. So we're aligning the development of our properties with government funding timelines. So not only do we need support from the federal government to create the funds that can be parceled out by the jurisdictions, we have to align with all of those different timelines of when that money is available. And it's not one source of government money that's coming in to fill the gaps at the bottom. It's multiple sources.
Yeah, and so that's perfect. You guys are so good. You're following my outline here, and you don't even have. I never even gave it to you. So this is perfect. I mentioned earlier lasagna.
Yeah.
And you're probably the #1 panelist on that stage that understands what that means, because typically you just have debt and equity and maybe some early money, a little mezzanine stuff. But it gets complicated, layer after layer after layer, ergo lasagna.
Yeah.
You want to tell the audience a little bit about that?
So we do have equity in affordable deals. It's called low-income housing tax credit equity. So these are people who are buying future federal income tax bills. So instead of paying $1 million in federal income taxes for the next 10 years, you can buy a low-income housing tax credit and pay $10 million today to get $10 million off. You're not paying 10 today. You're paying 9 today to get $1 million off your federal income taxes for the next 10 years. So these are big institutional types of investors. They're not getting cash return. They're getting managed federal income tax risk mitigation, in essence. They're also getting losses and depreciation and things like that. And they're getting CRA investments usually. So they're banks and people that need those types of investments. So that's the equity bottom that we have in our deals. We still have debt at the top, but we try to make it as small as possible. And then in the middle is soft debt. So soft debt is not foreclosable. It's pay percent of cash flow. So I know that kind of blows everybody's mind, but that is debt that we get from government entities. This is the strings attached money. The equity, the tax credit equity comes with strings too. But the government entities will give us money or loan us money that says, okay, well, we'll take 25% of your cash flow towards the repayment of this loan at the end of your year or at the end of each quarter. So again, that comes with the restrictions, a 30 or 40 or 50-year restriction on rents. So we know that going up front, it's kind of a version of rent control, but that's what gets the financing together that allows us to charge less rents because we don't have to pay that big mortgage payment each month. So
right. First time I heard all this stuff, I had to take notes, and then I said, we need to go to lunch. So do you deal in that realm as well?
We also do the lasagna financing. And really what I want to touch on is that soft debt that Tim was referencing. And so 4 years ago, a 200-unit community needed about $3 million of that soft debt. Today, these communities are over $15 million of that soft debt. And that's really just because of the rise of construction costs in relation to the rise of the area median incomes. And so that gap has grown. And the challenge is the availability of those soft funds. So the county is a huge contributor with the Clark County Community Housing Funds. The state had a great allowance with the Home Means Nevada initiative. The state also leverages a state tax credit program. And so really what's also happened though is as other developers have started to go shift or recognize that maybe market rate not be as viable right now, is a lot of groups have leaned into affordable housing, and that scarcity of soft funds is really putting a little bit of a challenge for the future of affordable housing.
I'm just curious, in this soft debt component, how many different agencies are you guys working with to make up that portion?
It depends on the deal. Obviously it's better if it's just one, but it's usually at least 2 or 3. Sometimes it's 4. So we'll have Nevada Housing Division. We've got Clark County Community Housing Fund. City of Las Vegas might be in. So 3 is common. If you're really doing a multi-jurisdiction effort, we're doing one right now that focuses on foster youth aging out of foster care. So we actually have 4. So we have City of Las Vegas, County, City of Henderson, and State of Nevada all helping fund that.
And are they pretty collaborative?
And it's in the City of Henderson. Different jurisdictions, we all, everybo's bought into the vision of that property or that project, why we're doing it. You gotta work through all the angles though. Affordable housing cannot work without the jurisdictions though. So again, federal has to be there, the state has to be there, and each county and city has to be at the table. And it's a negotiation about what can be achieved and what the deal can perform at.
Yeah, the 3 to 4 I'd echo. And then really I was mentioning that BLM portion too. While it's not a dollar contribution, it's free land, which in essence is soft dollars basically.
Fair.
See, doesn't this just make your job seem easier?
Yeah.
Absolutely.
Closing calls have like 50 people on them.
I'll add, we're doing an affordable deal, and it's 3 sources of soft money, but all this stuff takes time. They all have different application processes, and this gets back to land and having to get the land seller to ride with you for year and a half to 2 years, the time to do an affordable deal and to make sure that lasagna comes together is quite time consuming.
Yeah.
All right, perfect. There's so many questions that we could talk about financing, and of course I mentioned earlier when I met you, you're the genius on this stuff. This girl's got financial background that she should be in New York somewhere, I don't know why. So we've talked about financing, and my question is, at least from the investor side, what sort of returns are they looking for?
That's a great question. So I was marveling at how complicated your guys' job is with...
I'm putting in a raise for each of you.
Yeah, the lasagna layering. I think Jonathan said it well. Typically our deals are just debt and equity, and we're looking for, call it 60 plus or minus 5% on the leverage point for debt. And I won't sing too many praises because I have some of my lenders in the audience, and I want them to continue to compete for our projects. But by and large, the lending market has been rather healthy lately, and there's a lot of liquidity flowing through there, and there's a lot of competition. So that piece, I wouldn't say is easy, but I think it's much healthier than it has been in the prior, call it 2 to 3 years. Now, the equity piece is what is challenging. So we've capitalized 3 development deals in the last 6 months. And, frankly, I think if you were to talk to the rest of our executive team, our ambition would have been to do 10. But it's just kind of where the market is. And a lot of that is based on the fact that equity partners are looking for your untrended return on cost to be somewhere around, call it 6.5 to 7. And so what that means is you're untrended, and sorry to give you guys some math equations here, but I think it's important because this is a very focal metric that groups use to evaluate profitability. But it's essentially, where is your stabilized NOI going to be as a percentage of your cost? And for something to pencil to a 6.5 or 7 untrended return, you are either having to really control your cost, whether that's in land or construction, or you're having to bank on pretty healthy rents. And so across our portfolio, we've got maybe 8 projects in various stages of pre-development or under construction, and we've got, call it 1 project that clips a 6.5. It's kind of closer to a 7. And it's still difficult to bring capital to the table. And part of that is because when you're looking at your untrended return on cost, you have to compare it to, a more risk-off investment, which could be a cash-flowing multifamily deal. And when you're looking at cap rates for those, you want to see a pretty healthy spread between what is the cap rate for an existing deal versus what is your untrended return on cost for development. And you want to know that incremental risk for taking something from a dirt site to a beautiful shining building is actually going to pay you more than what you would make if you just went out and bought a stream of cash flows. Right. And so that's really where we're seeing a lot of challenge from institutional capital bringing money into development deals.
And so your market rate stuff would be...
Yeah, I would agree. I think the investors are looking like at a 6.75 return. I would also agree that the construction lenders are to a point where they've had a lot of redemptions here in the last 18 months, but there hasn't been the volume of new starts, and so they need to get that capital out. But there's just an environment out there where people don't want to be the first mover. For better or for worse, I probably will get in trouble for saying this. That they don't lose their job by not investing right now, and so it's a safe play for them to sort of sit on the sideline.
See, now, so you can start to understand that these folks have to figure all this out before we put a shovel in the ground. All of this has to be vetted, and you keep talking about entitlements are already done, so you've already had to hire those pesky architects and engineers to prepare those plans and get them through the cities having jurisdiction. So we've touched on how this process is working. We've talked about demographics. Let's talk about the one thing that we all struggle with, construction costs. He just shrugged his shoulders, like, no big deal.
Well, it depends. It goes like all these different levers. Some are challenging at different points in the cycle. And right now, it's financing. Construction costs are pretty flat. And it's it's basic supply and demand. There isn't a lot of new multifamily starts out there, and so costs are in check. But 3 years ago, construction cost was the biggest challenge that we had in terms of getting a new deal started. So It's all cyclical. Different times, one of the levers would be tougher to get a deal done. But right now, construction costs are pretty in check in my mind.
Boy, you need to come to my office because we're struggling.
I
You
could
see the
add-
same thing?
Yeah, I mean, I could add to
Flatten
the
it out?
fact that, so 10 years ago in Vegas, you could build an apartment for about $167,000 a unit.
Right.
Now it's north of 300. The challenge is, while costs have like leveled, they're sticky. Like, they're not going to go back down really much more. And so, I mean, that's going back to like investment thesis and all of that. It's, if you can get in at a good basis right now, if you believe in the long-term growth where that you'll lock in that cost basis, but in 5 years, maybe the rents will balance out. If you have that staying power, is what's going to get communities out of the ground right now. But yeah, I mean, luckily, to Jonathan's point, is like, there's subs who want to work right now. There's people, like the workforce is ready and subcontractors are ready, but prices are sticky.
You seen that too?
Yeah, I mean, it's an ebb and flow. I mean, there's risk with lumber prices going up and down. There's, it's evened off a little bit, but for a while, especially, I assume everybody was fixated on switch gears and ordering switch gears in time, and there was a huge lead time to be able to get your electrical system going, because it's all, anyway, it was just a stuck market. Construction is okay right now, and in some places it's coming down a little bit.
All right. So let me ask you this then. When you're approaching a project, naturally you've got so many doors you want to place on this property. You talk about 5 acres, 6 acres, 7 acres. You probably, in the back of your mind, pretty quickly can determine exactly how many doors you're going to go, depending on how you're going to go. 2, 3, garden style, walk up. God forbid we go to 4-story and we have to do elevators, cost goes up per door. What's your favorite product type? What are you leaning toward mostly? Is it the 3-story walk-up, or depends?
Yeah, it very much so depends on the site. We are, I'd say, leaning more towards 3-story interior corridor. And so it's garden style. You have your surface parking, so you don't have a huge cost factor for any kind of structured parking. We see that interior corridor does command a slightly higher rent, especially when you're selling your 3rd or 4th floor unit, or I'm sorry, renting your 3rd or 4th floor units, and having to move in tenants in the middle of a Las Vegas summer. It helps justify that. You also can kind of look a little more favorably on some of the premiums that you charge there. But by and large, I would say, garden style, 3-4-story interior corridor.
So let me layer the question then a little more. Where do you see your sweet spot in terms of number of doors on a project per phase? I mean, nobody wants to build 500 units at one time, right? Because you can't absorb that. So what's your sweet spot?
Keeping it under 300 units.
300?
The challenge is you don't want to be leasing up on yourself. You want to get it leased up within the first 12 months.
Right.
And when you don't want to start dealing with the renewals and still be leasing up. So you want to be doing about 25 to 30 units a month and trying to get that done within a year.
Okay, good sales force if you're doing 30 units a month. That's good.
Yeah.
You seen the same thing?
Yeah, and I mean, I just want to go over like the evolution. Like Ovation used to do the garden style communities. We haven't built a garden style in the last 10 years. We feel like the marketplace does like that interior corridor. And 200 is like this on a 5-acre piece is a nice sweet spot. And then obviously some of these sites in great locations, you can go higher, but that lease up cannibalization risk is definitely there.
Our most common property size is 240 units. We'll do that in both senior or family. The senior buildings will have internal corridor and elevators. Our family product generally is a 3-story walk-up in 24 or 36 units per building. But to your question, my personal favorite is no age restrictions. So 1 and 2 bedroom without age restrictions. I think there's a huge, well, I don't think, you can see the data. There's just a huge number of people that are in our right income group that are less than 55 that they don't have big families. There's just a lot of people living single.
Right.
lives these days that are 40,000, 30 and 40,000. Our average income is about $30,000. So a one bedroom serving a $30,000 person in an elevator building with no kids, they're working, would be great. So we're doing our first building that way in a downtown location that I'm excited to see open up next year.
Really quick, could I add something there? Just like that, because before there's senior and family, and we're trying to change that narrative of it's not family housing, it's just non-age restricted workforce housing.
Exactly.
It does face a little bit of NIMBYism compared to senior housing, and that's a bit of the challenge as well.
Yeah.
So,
Sorry if I can add.
No.
I would agree. I think the family component of your tenant base is becoming more prominent in the Valley. We don't do a lot of it, but one of our favorite projects that we just delivered is a BTR community out in the Cadence Master Plan. And it is, it's kind of bungalow style where we have all single story and then a handful of two-story homes, but detached homes, a handful of tandem duplexes. But you get, a small backyard. You have more of a sense of, residential for sale community instead of kind of higher density multifamily community. And we absolutely love it. I mean, we wish we could do more. I think the demand is there, but unfortunately, in a market like Vegas, you need more density to justify the land cost. But it's a really cool play because I think in a lot of other markets where you see BTR is kind of in your second, third, deep suburbs. And for us to be able to build it, in a location that's not only, one of the best master planned communities in the country, but also call it a 15-minute drive from several different employment nodes, it's been a great delivery for us.
Well, that's one I didn't anticipate you talking about. Some of my wife was asking me last night, what about single family and where are you going with that? So maybe you can talk to her about that later.
Yeah.
So BTR, I don't know if everybody got BTR.
No, I was
so
gonna ask,
build
what
to
is that?
rent is
Build
like
to
a
rent.
single family product that's run as apartments. So that's what that
Yeah,
means.
thank you.
So,
Thank
sorry,
you. Exactly
in case
right.
that was new to people.
Acronyms, we can never have enough. Speaking of all of that great product that you're talking about, are you seeing the revenue side working for you? Where are the rents at? Talk to us about, are they ticking up or are they flat?
So our rents are government regulated. So the big day for us is next Friday. The new rents will come out by the federal. They're supposed to come out on April 1st, but due to the government shutdown, they're delayed to May 1st. So we'll know what we're allowed to charge. Again, all of our rents are between $500 and about $2,100. So that we expect that to go up. I don't know what you think, Armen. I think it's going to go up about 5% or so. That'll allow us to raise rents at renewals. We are seeing a little bit more concessions in the marketplace. So we have maybe 10 of our 36 properties that are doing first month rent concessions, which is unusual for us in the affordable realm. We usually never have to do concessions, but we are doing a few concessions to get people in and keep our occupancy. Again, our occupancy is usually 97 or 98% occupancy. So,
yeah, I feel like rents are generally flat, slightly down, concessions in the marketplace. I think what is interesting is kind of the convergence of affordable housing rents and call it more Class B multifamily. So year over year, these past years, like the AMIs went up like 8-9%. And so the rent growth that was happening in the affordable housing communities was at a pretty rapid pace, but was also happening in market rate units. But as market rate units flatten, it's getting a little bit more convergent. Yeah. And I think that's what Tim's talking about, depending on the location, like concessions needing to be offered even at some of these affordable housing communities, because there's a 15-year-old product at around the same price, maybe even $50 cheaper. And if that last $50 makes a difference, it's the consumer's making that choice.
Jonathan, concessions on your side?
We have 3 deals that are in lease-up right now, so as part of the lease-up process, we are doing some move-in concessions.
Okay. Miranda, same thing?
Yeah, same thing, particularly with new supply, for sure. We're actually starting to see some positive rent growth on some of our existing assets for lease trade-outs. So that's, it's a good sign.
It's another green light. I like to hear that. Are you all happy with our regulatory environment? When you buy a piece of land, you feel pretty good about it?
As a developer that develops in California, I'm very happy with the regulatory environment here in Nevada.
Yeah, Scott Carter's in the audience here from North Las Vegas. He's happy to hear that. And all our planning departments. It's true. I do work.
It's a true story. We could build we go through 2 deal cycles here in Nevada. We can find a piece of land, build it, sell it, find another piece of land, build it, and sell it, as it takes to do 1 deal in California.
I rest my case. Class dismissed. That's great to hear. Obviously, we know we complain still about our regulatory environment, and we still got to go through planning, getting entitlements. But it's true, when I have developers come in from other parts of the country, they go, you can get this thing done in 6 months? What? That's crazy. So we should be very grateful for what we have. We continue to work on making it better and more efficient. But I'm glad to hear that regulatory concession or regulatory requirements are not killing us. How are we doing on time here?
Mr. Vance? Hello, how are you? Thanks, Ed. We have tons of questions. We'll try to get back to you a little bit. Thank you, Chad Jacks, for telling us that data centers and homes can live together in this community. Thank you a lot. I'd like to recognize Mike Showett, who used to be the head of Nevada Hand and board member of NAIOP. Jess Mulaski of the Mulaski fame is here from Ovation, and that's great to see. Legendary Erwin Mulaski. And Danielle Casey from LVGEA. She brings all the businesses that all of us build. So we thank her a lot. Today I'm also going to not drop the mic, but I'm going to pass the mic over. This will be my last day on the microphone. It was a great run. I had so much fun, and I think we all had fun together. I want to thank Reed and Hyam that started me with all this years ago. NAIOP, this job, I was like the house guest that would never leave. So I don't want to be that. And NAIOP's just a wonderful organization, and I thank you all very much. Thank you. Thank you. We had a lot of fun. Most of the questions we received had some brand of redevelopment in them, whether it was rehabbing, which I know you guys probably don't do exactly, but is there a market for rehabbing existing apartment units out there that's giving you some pressure, and or rehabbing, taking down some commercial centers, which I think both Miranda and Jonathan have done. So if you guys can touch on rehabbing and redevelopment, all of you individually and collectively, you'd answer a lot of questions that we have.
Tim raises his hand.
Rehab, at Nevada Hand, our company is 30 years old, so we have we have properties that are old, we hold them, and they're ready for rehab. So we just got financing approved yesterday through the state for a rehab of 274 units of family housing, 1, 2, and 3 bedroom apartments that was built in 2001 at Fort Apache and Tropicana. So we'll start that later this year. It'll be phased, so it'll be 2 years of construction because we only do so many buildings. Rolling rehab, moving, relocation, moving families, all the things like that. But it is a third. We try to do 2 or 3 construction and 1 rehab project a year. So it's definitely a business line for us, and we like to do it. It keeps our assets current and refreshed. There's fees associated with contractor fee, developer fee. It's a good business, and it preserves long-term affordability for that property. So it's good for us.
Yeah. On the affordable side, we're not quite as old on affordable, so our communities are at year 13, call it. There's a unique process in affordable housing communities that tax credit investor at year 15 comes out and allows for opportunities for that rehabilitation. So we're looking forward to doing that. And then on the communities we own, we just broke ground on a pool remodel at an apartment community in Summerlin, but not necessarily doing major rehabilitation at this point.
We've done some affordable rehabs. The challenge is the relocation of the tenants. We're primarily a construction company, but that is a real challenge, relocating the tenants and sort of quarterbacking that process along with how you do the construction. On the market rate side, I'll say we've sort of had a business thesis where we've done some of these infill developments where we've scraped existing buildings and gone into sort of the core and gone vertical with a new development. We've done a lot in the Chinatown area. We've taken that experience from other markets that we've done. We've done a lot of that in Portland, but we think Las Vegas is ripe for some infill development.
Yeah, I would agree. We don't have a specific strategy carved out for it, but we do have a project we recently delivered. It's called The Collective, and it was originally kind of 1980s retail, and then there was an office building on the backside that had just been vacated, and it was a covered land play for us, and it's, call it 2 blocks from the Sphere, and shameless plug, it's got some phenomenal restaurants in the retail center now, so next time you guys go catch a concert, check out some of them. But it was a great opportunity because it was a QOZ, so we got enhanced tax benefit for it. Right. And then it also sits across the street from one of the most successful deals that we've done, which was at the time Elysian at Hughes Center. And we cleared, kind of top of market pricing on that project. So having such conviction in the tenant demographics and knowing that micro location made taking down the land, directly across the street, that much more, convicting. And so that's one. I will say, I think going forward, it's probably going to be more of a focal point for us, just because, as we talked about earlier, the availability of raw land is becoming so limited that I think you're going to have to start looking at repurposing some of these existing sites, like Jonathan said, with Chinatown. You've got a ton of great sites just along the Strip that have just been neglected and can use some reactivation. And then you see everything that's going on in Symphony Park and the Arts District. So I think you're going to start seeing that spread out further into other parts of town, especially as land scarcity continues to grow.
Okay. Dan, did you have any other questions you wanted to ask?
Tons of questions, but one of them, what's a panel without an AI question? One of the questions is, the bad side of AI, renters using false backgrounds and this and that to get, I see Jonathan shaking his head, yes, so he has an answer for this. And is there some good parts of AI that you're using in your businesses?
An applicant probably can have pay stubs, employment verification done in 30 seconds on AI right now. It's a constant battle with the fraudulent applications as a result of AI, but we are sort of attacking the AI with AI, and now there's some good AI tools that can flag and identify these fraudulent pay stubs and fraudulent employers. So that's where we're using it the most is on the property management side, a little bit on the construction and the design side, but primarily just sort of to combat the fraud on the application side for the renters.
We're slow in adoption of many things in AI. Our income verification and all of the verify income for tenants is very kind of IRS focused because it's all an IRS program. So it's got to match up, and so using AI to verify that is hard to do. But we are looking at maybe more of a chat bot for our call center, our 24-hour call center. That may seem like old hat to most people in multifamily, but in affordable, it's just a little bit. Also, the software, the AI companies are not as evolved in doing the leasing and work orders on the affordable software that they are for market rate. So we're just behind, probably.
There's a little bit on the design side, like for site planning, you give us some unit plans. Sorry, Ed.
Okay, I'm going to report you to the State Board of Architecture. Can I get a phone?
But I do feel like a little bit of the leasing future. I mean, I don't even think we have after-hours calling right now, so it's good to hear you even have a call center. Yeah. But there is this whole Elise AI of having the community be able to connect after hours, or like self-guided tours is also something in the horizon.
That's good.
Yeah, we use it in a lot of similar ways to what's been mentioned. Another way that we're using it is on deal sourcing. So in, building our assumptions and our underwriting models, kind of using data that's available, whether it's on third-party sites, whether it's through broker materials, whether it's from our own portfolio, and being able to decipher it into something meaningful in, a matter of minutes versus several days or hours, it's been an incredibly helpful tool for us.
And we use it a lot, and it's helping us get our jobs to supply you with what you need as quickly as possible. Daniel, how are we doing?
I'll ask one more. There's still plenty, but one of the fun questions is are Miranda and Jonathan not wanting really to sit next to each other because they're competitors? Whoever wants to answer first.
So, it's not a problem, and then I think the development community, especially the multifamily community, is very collegial. We're all good friends.
Yeah, it's a small playground, I'll say that. Yeah. Both in Vegas and in other markets, right?
Yeah.
Blame it on the scarcity of land, which NAIOP's trying to solve. Ed, thank you once again, everyone in the audience. And Ed, why don't you take us home?
Thank you, Daniel. And we're going to miss you. This is such sad news. I have to say that you've been incredibly intelligent and given us a great deal to think about. And I'll sort of give you a closing question, and you can answer it as you wish. But as we talked about, it's not just delivering units anymore. We're building communities, and it's not just a financial equation. It's really the foundation of an economic stability and a quality of life, really, when you think about it. So I'll close with this question. Each of you answer this. What gives you the confidence that we can still deliver meaningful housing solutions in Southern Nevada over the next 5 years? Future.
What gives us confidence that we can, I love working in the affordable space. The letters and appreciation we get from residents, all of our communities have resident service coordinators that do, our tagline is more than a home. So it's not only it's rent, but it's access to food, transportation, health services, aftercare programs for your kids, housing stability resources, utility assistance. So I like working in this space. I don't know if you all know this, but Southern Nevada is the #1 metro for the biggest gap between the supply and demand for affordable housing. So I like working in that market that's trying to serve the biggest need in the country. So I think we have a bright future, and I'm happy to do what I do. Mm-hmm.
Yeah, Las Vegas as a whole is a real workforce city, and multifamily is really workforce housing. It's great that we're even at the affordable level going down to 30% area median income, but with the rising cost of home ownership, it's left individuals or families below 150% of area median income without housing. And so that's really what we view as building well-designed communities that have community that help house our community.
So.
We talked on it a little bit. I think, Southern Nevada's pro-business, pro-growth. The business leaders, execute that plan. You see it with stuff like the Tesla Loop. You see it with the sports teams coming here. That's where our investors want to be. They want to be in growing cities that are on a positive trajectory. There's dying cities out there, and I think the business leaders, the government leadership has made Southern Nevada a desirable place for our investors to be. So that's why I think we'll be able to continue to deliver quality housing here.
Great.
I would agree. I think I would say focusing on the tenant side, it's the sense of identity and community that they get from our properties. With our footprint being the size that it is, we are able to deliver an experience that goes beyond just a roof over your head, and it starts to connect people to one another. And when you look at our tenant demographics, we have a lot of single professionals. We have a lot of young people that are moving to Vegas from other states, and then we have a lot of retirees. So you're admittedly in these seasons of life where there is some solitude, and the fact that we have such a social nature to our communities really allows people to start connecting and building deeper roots into Las Vegas as a whole. And we see that when we've got tenants that'll move from one Elysian property to another, kind of just based on their desire to stay within the family.
Thank you all. Aren't these guys great? Round of applause for everybody. And now you can all take the rest of the day off. I think that wraps it up. Mr. President?
Very good. Thank you guys very much. These are the folks, these four companies are the ones that have been doing density in this valley for decades. There are a lot of folks that think that density is the solution to everything, and these are the ones that have been making it happen here for decades. And I want you all to know that you're welcome here, and we want you here every single month. One of the messages they conveyed was that land is an issue. Next month, we're doing a lands panel. Dan mentioned it earlier. NAIOP has been at the forefront of really fighting for this land issue, and it's going to be a great program, so please come back next month. Thank you guys very much. That's Thursday, May 21. Thanks to our program sponsor, Nevada Energy, and for all of you attending via Zoom and in the room today. Have a great day. Thank you.